Welcome. In this lesson, we are focusing on elasticity. So what is elasticity? It measures how sensitive people are to a change in price. If a price of a good increases, do people stop buying it or do they continue buying it anyway? That is the question that elasticity addresses. This formula here, it's a formula of price elasticity of demand. It compares how much quantity changes relative to a change in price. What we would like to know is whether price elasticity of demand is elastic or inelastic. Let us look at the next example to understand the concept better. In this example, we're comparing a change in price of a luxury good and petrol. If the price of designer clothes increases, do people still buy as much? I don't think so, because there are substitutes. Therefore, quantity drops a lot, and we say that demand is elastic. If the price of petrol increases, do you stop driving? Certainly not. You will probably change your driving behavior, but you will continue going to work, you will continue going to school, businesses will continue. And therefore we say that quantity changes very little and demand is inelastic. So elastic demand means that consumers react strongly to price changes, whereas inelastic demand means a change in price, consumers barely react to it. So elasticity, it tells us how much behavior changes when price changes. Let us revisit the equation again. So if PED is lesser than 1, we say that it is elastic. That is, a change in price leads to a big change in quantity demanded. It's very responsive. And if it is lesser than 1, we say it is inelastic, it's not very responsive, and change in quantity is not as much. If it is equals to 1, we say it's unit elastic, that is percentage change in quantity demanded equals to percentage change in price. Let us look at our first example. Suppose a price of a soft drink increases from 10 Rand to 12 Rand. As a result, quantity demanded decreases from 100 units to 70 units. Calculate price elasticity of demand, and secondly, classify the type of elasticity. So we have agreed that PED equals to percentage change in quantity demanded divided by percentage change in price. So change in quantity, you'll agree with me that it decreasing from 100 to 70. So the change is 70 minus 100 divided by 100 to get to the percentage change, right? And change in price, it's from 10 Rand to 12 Rand. Therefore, it's 12 minus 10 divided by 10. So, to make it easier, or for those who want to remember it better, we will say that it's new quantity minus old quantity divided by old quantity. And new price minus old price divided by old price. This gives us negative 0.3 divided by 0.2 and an answer of negative 1.5. However, remember that the answer must always be an absolute number and therefore it is equals to 1.5. Let us go back to our classification and see what this means. 1.5 is definitely greater than 1 and therefore we say that it is elastic. So we say our price elasticity of demand is elastic. That is, a change in price leads to a higher change in quantity demanded. That is, it's very responsive. And this you can see by just changing this equation into a percentage. We can see here that price changed by 20% and quantity changed by a higher percentage, 30%. And therefore we say it's very responsive. It is elastic. Let us look at our next example. Suppose the price of petrol increases from 20 Rand to 22 Rand per liter. As a result, the quantity demanded decreases from 100 liters to 95 liters. So calculating our PED, we get 95 minus 100 over 100. Remember, it's new minus old divided by old. And 22 minus 20 divided by 20. And our answer is minus 0.5, and we turn it into an absolute number, which is 0.5. So, going back to our classification, 0.5 is definitely less than 1. Therefore, we say it is inelastic. That is, it's not as responsive, and quantity changes very little compared to a change in price. As we can see here, okay, this is our second response showing that PED is inelastic. But also, if we convert this into a percentage, we can see that a percentage change in price of 10% leads only to a 5% change in quantity demanded, and therefore making it inelastic. Let us go to our last example. Suppose the price of t-shirt increases from 100 to 110. As a result, quantity demanded decreases from 50 to 45 Rand. We get an answer of minus 1 and an absolute number of 1. And we know when we look at our classification that if PED equals to 1, we say it's unit elastic. Meaning that a percentage change in quantity demanded equals to a percentage change in price. And we can see this by converting this equation here into a percentage. It's a change of 10% in price leads to a change of 10% in quantity demanded. But what does this all mean? Yes, now we understand how to calculate and classify our elasticity. But what does it all mean? So what is the importance of elasticity? When it comes to business, if PED is elastic, remember elastic, it's responsive to a change in price. It means if you increase prices, sales will drop because remember that we have substitute. And as sales drop, it reduces revenue. And if it is inelastic demand, you can change prices because the change in quantity demanded will be very small and you can increase revenue. Government use elasticity when setting taxes. They tax goods with inelastic demand such as fuel or cigarettes. And you also need as a business to understand consumer behavior, that if there are substitutes, how will they behave? And if a product is a necessity or luxury, how will they behave? This here is your homework. Read the question and respond to the 2 questions below and put your answers in the comment sections and I will mark it. Our next session will be on price elasticity of supply, on income elasticity of demand, arc elasticity of demand, very popular in exams, and cross price elasticity of demand. Please remember to like and subscribe. See you in our next session.